Hello guys, welcome to the P4 webinar session. Today we have a discussion of your mock exam. It's a September-December 2016 past exam paper. And the first question is from cost of capital. So the first question is from cost of capital, business restructuring, and the risk management, the general risk management theory. The second question, the firm has scored. It is from investment appraisal. It's a very easy question. Simple investment appraisal. And the third question is from dividend policy. And the fourth question is from interest rate swaps. So starting from the very first question, the first part is explain how business risk and financial risk are related and how risk mitigation and risk diversification can form part of a company risk management strategy. So in order to answer the very first part, you need to know the business risk and the financial risk and the risk mitigation and risk diversification strategies. What is business risk? In business risk, it depends upon the nature of business. What are you actually doing? What's your nature of business? What are you selling? And how the economic environment has an impact on your sales, on your inventory level. So the very first part in business risk is the nature of business. What are you doing? Are you selling the luxury item? Definitely your business will be risky. Are you selling the necessities, the basic need of life? Definitely your business will be less risky. So nature of business, business risk depends upon the nature of business plus fixed operating cost. If your fixed operating cost is high, if your fixed operating gearing is high, that means your business will be high. And if your business risk is high, you can't afford to have some financial risk. So business risk depends upon the nature of business. Business risk depends upon the nature of your operations, your business, the nature of your sales, your marketing, and the nature of your products. And the financial risk is the capital expenditure, the capital gearing, the financial gearing. If company has not borrowed, from the market, your financial risk will be zero. Financial risk, it all depends upon the nature of capital structure. It depends upon the borrowings. If you have high level of borrowings, definitely you will have a high level of financial risk. So financial risk will increase with the level of borrowing. Whenever there are high level of borrowing, your financial risk will be high. Okay, the next is risk mitigation. And risk diversification. Risk mitigation means you are going to mitigate, you are going to reduce the risk by hedging, by taking the insurance, by transferring the risk. So in risk mitigation, you will do the insurance, you will hedge your risk, or you will eliminate the risk by transferring that risk to the other party. And in risk diversification, you will try to invest into unrelated business. You will try to invest into unrelated business, which will reduce your risk. Which will reduce the risk, because risk will be average out when risk is risk will average out when risk is spread between the different businesses. So that's what the first requirement is all about. Second is prepare a report for the board of directors of Murata company, which estimates Murata company cost of equity and cost of capital based on market value of equity and debt. So you need to calculate market value of equity and debt before any changes. That means you have to calculate current cost of equity and current cost of capital, and then after implementing the proposal, you will have to calculate the cost of equity and cost of capital. That is of 17 marks. Okay, the second one, estimate the impact of the first and second director proposal on Murata company's forecast after tax earnings. So you need to evaluate your comment, your proposals on their impact on the EPS and on the financial position. That means of balance sheet. That what you have to estimate in second part. It's of 7 marks. And third, discuss the impact on the Murata company of the changes proposed by the first and second director. Recommend whether or not either proposal should be accepted. Discussion should include the explanation of any assumption made in the part 1 and part 2 of the B part. So the professional marks are available. In third part, discuss the possible reason for the third director proposal that a risk management system should consider each risk before taking appropriate action. Okay, let's start with the question. This company is involved in, this is his first business, and maintenance its second business. So this company is offering 2 services: travel business, travel services, and maintenance services. Okay, this is the general detail. Now let's, next paragraph, following a long discussion at a meeting of board of directors about the future strategic direction which Murata company should follow, 3 directors continued to discuss one particular issue over dinner. In the meeting, the board had expressed concern that company was exposed to excessive risk and therefore its cost of capital was too high. Board feared that several good projects have been rejected over the previous 2 years because they did not meet the company higher cost of capital. Each director put forward a proposal. These are the different proposals of the directors, and we have to evaluate. So let's start with the first director proposal. First director is of the opinion that company should reduce its debt in order to mitigate its risk and therefore reduce its cost of capital. He proposes that company should sell its repair and maintenance services business unit and focus just on offering bespoke travel services and hotel accommodation. In the sale, the book value of non-current assets will reduce by 30%. So that means you are going to sell repair and maintenance business. And in that case, your non-current asset will reduce by 30%. Current liability will reduce by 10%, and non-current asset will be sold at a profit of 15%. First director suggests that fund arising from the sale of repair and maintenance services unit and cash resources should be used to pay off 80% of the loan. It is estimated that as a result of this, company credit rating will improve from Baa2 to A2. This is first director proposal. Okay, what about the second director? second director is of the opinion that risk diversification is the best way to reduce product company risk and therefore its cost of capital. He proposes instead of selling the existing business, he is proposing that company should invest in a new business. And new business will be on construction of the new commercial properties. The second director suggests that 70 million should be borrowed and used to invest in purchasing non-current asset for the construction business unit. So you will borrow the additional 70 million. The new debt will be issued in the form of a 4-year, okay, the 4-year redeemable bond paying a coupon of 6.2. It is estimated that if this amount of debt is raised, company credit rating will worsen from to CA3 from BAA2. And current liabilities will increase to 28 million. So in first proposal, the first director was selling the existing business. In second proposal, the second director is investing in the new project. Okay, what about the third director proposal? The third director is of the opinion that company does not need to undertake the proposals suggested by the first director and the second director. So third director is rejecting the first two proposals. She feels that the above proposal require a fundamental change in corporate strategy and should be considered in terms of more than just tool to manage risk. Instead, she proposes that a risk management system should be set up. The whole risk management system should be set up to appraise company current risk profile, considering each type of business risk and financial risk, and taking appropriate action to manage the risk where it is necessary. Okay, the non-current assets, current assets, share capital, retained earning, non-current liabilities include the 6.2% bond. It's all data is given. And the next. Company forecast after-tax earnings for the coming year are expected to be 28 million. So the next year, earnings are given 28 million. It is estimated that company will make a 9% return after tax on any new investment. So second director was suggesting the new investment. So when you invest $70 million in the new assets, it will definitely increase your return by 9%. The first director was selling the existing business. So if you sell the existing business, you will suffer a 9% decrease in after-tax earning on any reduction in investment in non-current asset. Company current share price is 2.88 is the current share price. According to the company finance division, it is very difficult to predict how the share price will react to either the proposal made by the first director or the proposal made by the second director. Therefore, it is assumed that share price will not change. Although this assumptions require this is a very debatable topic. This is not a very good assumption, but in this question it is clearly stated that you will need to assume that price will remain constant. The finance division has further assumed that proportion of the book values of non-current asset invested in each business give a fair representation of the size of each business unit within Murata company. So that means as company is operating in two divisions, according to this statement, whatever the proportion of non-current assets, your division will have that have the proportionate size. So if we go to the previous page, the repair and maintenance services will reduce the non-current assets by 30%. That means maintenance division has a size of 30% If maintenance domain has a size of 30%, that means the travel domain must have a size of 70%. With the equity beta is estimated at 1.2, it's the current equity beta, while the asset beta of the repair business, repair and maintenance, is 0.65. Relevant equity beta for the new larger company, including the construction unit of the second director proposal, is 1.21. So it has been calculated. It is clearly given for the second director proposal. The bonds are redeemable in 4 years' time. For the purpose of estimating the cost of capital, it can be assumed that debt beta is 0. However, the 4-year credit spread over the risk-free rate is 60 basis if rating is A2. In case of first director proposal, 90 basis for Baa2, it is a current rating for the company, and 240 basis point for CA3. It is a case of second director proposal. Tax is of 20%, current risk-free rate is 3.8, and the market risk premium is 7%. So let's solve the very first part of part B. Okay, this is the answer. In order to answer the first part of B, obviously we are required to calculate cost of equity and cost of capital. So in order to calculate cost of equity, risk-free rate is given, beta is given, premium is there, and the cost of equity is 12.2%. What about cost of debt? The cost of debt is a formula of risk-free rate plus credit spread. So the risk-free rate is 3.8% plus, according to your current rating, your spread is 0.9%, that is 90 basis point. And if we add 90 basis point to the 3.8%, your cost of before tax, your cost of debt will be 4.7%. Okay, what about the market value? $2.88 market value per share is given, and number of shares are 125 million. If we multiply these, market value of equity is 360 million. And we need to calculate market value of debt. You can calculate like this. Here, obviously, company is a 4-year debt structure in cash flow. Every year you will receive the coupon, and at the end of the 4th year you will receive the par value, and the required return is 4.7%, the YTM. So if you discount these cash flow by multiplying 6.2 with the annuity factor and multiplying 100 with the discount factor, so the present value is 105.36. As book value of bond is 120, if you go back to the question, it is exactly there, $120. Multiply it 105.36 and divide it with the 100. When you divide the book value of debt with the $100, it will be number of bonds, and when you multiply number of bonds with the market value, so the total market value is 126.4 million. So market values are there, cost of equity is there, before tax KD is there. Just put into the back formula. This is cost of equity into its value plus after tax KD into its value and divided with the total capital structure, the total of market value of equity plus market value of debt. So the current cost of capital is 10%. Let's move if the first director proposal is implemented. If first director proposal is implemented, we need to calculate four points like in order to calculate WACC, we need cost of equity, we need KD, we need market value of debt, and we need market value of equity. Market value of equity is same exactly 360 million, and we need to calculate KD and market value of debt. And remember, in the first director proposal, your rating will improve and the spread will be 3.8% plus 0.6, that will be 4.4%. And if YTM changes, that means you need to calculate market value of debt again. So in order to calculate the market value of debt, the years are 1 to 4, cash flow is 6.2, 100, and if we discount at 4.4%, so its present value will be different. Its present value will be, if we calculate, if we took this figure from the answer, it will be 106.47. And the loan amount was 120 million. But if you pay 80% of the loan in the first director proposal, the fund which you raise after selling the maintenance division will be used to pay off your existing debt. So 120 million debt will only be now the 20%. Divided with the 100 value and multiply it with the 106.47. So the market value of debt will be 25.6. So you have calculated it will be 25.6. Okay, you have calculated equity value, debt value, KD value. Now it's time to calculate cost of equity. So the first step will be the company overall trades in maintenance and travel business. Overall beta is given, maintenance beta is given. We have to calculate the travel beta, because after disposing the maintenance business, you are now in a travel business. So first step will be ungear the overall beta equity of Murada Co. So how we have ungeared? Remember the formula? Value of equity, value of debt. The previous beta was 1.2, equity value was 360, and previously debt value was 126.4. So by ungearing, the Murada beta is equal to 0.94. So So it is 0.94. So overall, weighted average beta is given. Beta of travel into 70% plus beta of maintenance into 30%. How I have taken these two figures, 70 and 30%, because the straightforward assumption was given that proportion will be taken according to the weight of non-current assets. So overall beta is 0.94. We have to calculate this. And beta asset of maintenance is also given in question. That is 0.65. It was given in question. So beta of the maintenance is 0.65. Okay, if we solve it, we can calculate the beta asset of travel. Then you will have to re-gear it with a new gearing in order to calculate beta of equity. And new gearing is equity and debt. If we move to the answer, asset beta of travel, we have calculated 1.06. Re-gear it with the new gearing, equity beta is 1.12, cost of equity is 11.6, and by putting this cost of equity and KD, the cost of capital is 11.1%. Okay, what about the proposal of second director? You need to adopt the same procedure for the second director. In case of second director, you need to calculate four main inputs: KD, cost of equity, market value of debt, market value of equity. Equity value will be same, and according to the third director, according to the second director, new bond will be issued at the same coupon, 6.2, and you need to calculate its value. Your rating will go down to CA3, and for the CA3, the spread is 240 basis point. So let's move to the question. What about the cost of debt? Cost of debt will be 3.8 plus 2.4%. It will be 6.2%. And we know that coupon and by TM are same, so its market value will be exactly equal to 120, that is equal to book value. $120 is the existing debt, plus I think company has borrowed, if I correctly remember, company is going to borrow 70 million. So 120 plus 70 million. That's how you're going to calculate its market value. And what about KD? In KD, you need 3 points. Risk rate, it's available. Risk premium, it's available. The new beta, because now you have invested in 3 businesses: travel, maintenance, and construction. The new update beta is given in the question. The new beta is given, that is of 1.21. Okay, let's move to the answer. Market value of equity is same. Market value is this. Equity beta is given, so calculate cost of equity, and that's how you gonna calculate cost of capital, that is equal to 9.8%. So that's how you're gonna solve first part of the second requirement. If you have any question from this area, from the cost of capital, please write in the question box. Okay, what about the second requirement? The second requirement was okay. What about the second requirement? Estimate the impact of first and second director proposal on company forecast after tax earning and forecast financial position for the coming year. Okay, but let's have a look at the answers. So what examiner has done, write the current forecast that was given 28 million. Examiner has write it off 000, after tax earning the 28,000. Okay, according to the first director, you will pay your loan back, and definitely you are going to pay your loan. You will pay 80% of your loan, and 120 million, the 80% of 120 million will be 96 million. When you pay back 96 million, definitely you will save 6.2%. So the 6.2% of 96 million will be saved, but take its after tax value because you are going to adjust into the after tax earnings. So that's why you will save this. So your earning will go up. Okay, second, in the second director proposal, you will additionally borrow 70 million. And when you borrow 70 million, you will pay 6.2% interest on it, and your interest cost will rise, that is 3,472. And in the first director proposal, when you pay back, when you sell the maintenance division, your assets will go down. And what was the total asset value? I think it was 280,000. And the 30% of 280,000 means you will sell 84 million of your assets. And if you sell 84 million of your assets, you will lose its 9% value, that is 7560. And in second case, in the second director proposal, you will acquire 70 million debt, and by acquiring 70 million debt, you will invest in the new assets. So your income will increase by 9% on the 70 million. That is 6,300. And in the first director proposal, when you sell the assets of maintenance division, you will sell at 15% premium. That the profit on the sale of non-current asset is 12,600. So the increase in earning is 9,802, and here increase in earning is 2,828. Now, secondly, you have to make the balance sheet. So the current balance sheet is given. This is the current balance sheet. You have forecast this balance sheet for the coming year. Okay, according to the first director proposal, you will sell 30% of the assets. So this is remaining 70%. Equity share capital will remain same, and your retained earning will rise. How much your retained earning will rise? By 9,802. You will increase 9,802 into it. And in first director proposal, you will pay back the loan. 80% of the loan will be repaid. And current liabilities will reduce by 10%. It's all explanation is given in the question. In second director proposal, you will buy additional 70 million assets. This will be same. Retained earning will be adjusted by the increase or decrease in the earnings. Non-current liabilities will increase by 70 million. Current liabilities of 28 million is given in the question. So the current assets will be a balancing figure because there is no explanation of the current assets are given. So current assets will be a balancing figure because the balance of cash, the increase or decrease in cash will be present in the current assets. So that's how you're gonna solve the impact on the balance sheet. Okay, what you gonna do after doing all these calculations? Make it summary here. Current position, first director proposal, second director proposal. According to the current position, your cost of equity is 12.2, your cost of capital is 10%, and your earning is 28 million. And according to the first director proposal, your cost of equity will slightly go down, but your cost of capital will go up. Why your cost of capital is going up? Because you are reducing 80% of your loan, and when cheaper structure, when the cheaper borrowing, when the cheaper loan is no longer there, your cost will increase, because in back now there is no cheaper cost of debt. But the benefit is your earning after tax has been increased. But remember one thing, in this earning, one-off gain is added in. So this earning, which seems to be very good, includes a one-off earnings. Okay, in case of second directed proposal, cost of equity is almost same and cost of capital is marginally lower. And your earning after tax is marginally higher. It's not that much high, but slightly higher. So the first and second, both directors have not that much impact, have not that glorified impact on the company's results. So what will you recommend? It is recommended that neither the first directed proposal nor the second directed proposal should be adopted. Second directed proposal result in a lower return on investment and a virtually unchanged cost of capital. So there will not be a meaningful benefit for company. The first directed proposal does increase the return on assets, but result in a higher cost of capital. If the reason of adopting either proposal is to reduce risk, then this is not achieved. You have not decreased the risk. The main caveat here is that where the assumption made in the calculation are not reasonable, they will reduce the usefulness of the analysis. And what are the assumptions? The main assumption of that share price will not change. Obviously, it's not possible that you are selling your part of business, and it is also not possible that you are acquiring a new business and your selling price will remain same. So that's how we are going to tackle this question. So let's have a discussion on your questions from this part of the exam question. Let's move to the next question. Have a look at the requirement of the second question. Okay, the first requirement is evaluate the financial acceptability of the investment in Milan and calculate and comment on the investment duration. You need to calculate 2 points here. First one is NPV for the financial acceptability, and the second one is duration. We calculate the percentage change in the selling price required for the investment to have a zero NPV and discuss the significance of your result. It's a very simple question. You need to calculate the sensitivity analysis. That is NPV over present value of after tax sales. So evaluate the financial acceptability, calculate the percentage change in the selling price. How much your selling price will change if NPV becomes zero. So that is the sensitivity requirement from the B. Third, discuss the non-executive director understanding of the NPV. Okay, you need to discuss the NPV and explain the importance of other measures in providing data about investment short and long-term performance. Obviously, shareholders always require both the short-term and long-term performance. Some methods are for short-term, some methods are for long-term. Like short-term methods can be payback, and long-term method can be the NPV. So it's a very simple question. This is a manufacturer of mobile communication technology. It is about to launch a new communication device, which a director believe is both more technologically advanced and easier to use. Okay, this company will require a major investment. Company expect to sell these units in the first year. Sales volume is expected to increase by 20% in year 2, 30% in year 3, and same in the year 4. Okay, initial selling price in year 1 is expected to be $100, and this will increase with the rate of inflation then afterwards. Variable cost is expected to be 43.68 in year 1, and it will increase with inflation rate of the given inflation rate annually. Fixed cost is expected to be 900,000 in year 1, then subsequently it will increase with the given inflation rate. It's a very simple part. Initial investment is 16 million. Immediate investment in working capital is 1.02 million. Okay, the company will need to make an immediate investment of this in working capital. Working capital will increase annually at the start of each of the year 2 to 4. This is a trap. This is not that difficult statement. Start of year 2 means year 1. So this 1.02 is given okay. This 1.02 million is given in year 0, and working capital will increase at the start of year 2. Start of year 2 means year 1. So it's a very normal adjustment. So you will put 1025 in year 0, and at the end of year 1 it will increase with the inflation rate. Then at the end of year 2 it will again increase with the inflation rate, and in the last year it will be fully recovered. One of marketing expenditure is 1.5 billion, which is given post-inflation. Company tax rate is 25%. Tax is payable in the year the tax liability rises. Capital allowances are 20%. Balancing adjustment is required in year 4. Inflation rates are given for year 1 is 4% and 5% for the next years. Cost of capital is 11%. It's a very simple part. I think you have not faced any difficulty while solving this. Okay, these are units. This is selling price, and these are the inflation rates. This is selling price, this is inflation rate. This is a factor by which your units are increasing every year. Obviously, you can solve it in a different way, like 1, 2, 3, 4. In first year, units are 132. In year 2, it will increase by 1.2, like 20%. This will be 159,000. In year 3, it will increase by 30%. It will be 206,700, and in last year it will be maintained. That's how you're gonna calculate the units. Again, same is the selling price, and tax allowable depreciation is same. It's just a 20% on a reducing balance basis. And last year, all the balancing allowance, all the remaining balance will be a balancing allowance. So putting in these, you have calculated the present value, that is 7801. This question, especially the A part, except duration, has a level of F9. It's a very simple question. And in second part, you have calculated the duration. And how you gonna calculate the duration? Duration has, it's a very simple steps. Calculate present value. These are the present value. And then take the total of present value and divide each year present value with the total to calculate the proportion of total present value. So in first step, you have written all the present values. In second step, you have divided each year present value with the total present value just to indicate where bulk of the present value is there. So how are you going to calculate 16.5? By dividing 4104 with the total present value, then 5627 with the total present value. And the third step is calculate the weighted average years by multiplying each year proportion with relevant year. That like 16.5 will be multiplied with 1, 22.7 will be multiplied with 2, this will be multiplied with 3, and this will be multiplied with 4. And then by taking total, duration will be 2.78. This result indicates that it will take approximately 2.78 years to recover half the present value of the project. Duration considers the time value and the whole cash flows of the project. That's all. Examiner has only discussed 1.5, almost 2 lines. And in second step, you have calculated the present value of the revenues and just divide that present value of revenues with the NPV. Selling price is 18%. Selling price sensitivity is 18%. That means if selling price reduces by 18%, your NPV will be 0. That's a discussion here. Company would appear to have some scope to reduce the price in order to guarantee the success of the product launch. You have a scope of reducing 18% selling price. If selling price reduces by 18%, you will still be at break even. So it would be useful to know whether the finance director view on the success of the product would change if the product was launched at a lower price. There may be a scope to launch at a price which is more than 18% lower than the planned launch price. Increase the sale price subsequently by more than the rate of inflation if the launch is a success. That's how you're gonna manage the launch of the new project successfully, because you can reduce your prices now and increase that prices in future when your project will become successful. Okay, that's how you're gonna solve the question number 2. If you have any question, please write in the question. Okay, someone has asked, sir, why we have to reduce selling price by 18%? Okay, we are not reducing selling price by 18%. Actually, the sensitivity of selling price is 18%. That means if selling prices reduces by 18%, your NPV will become 0. That means try to understand the logic of the director here. We have a scope to reduce the selling price by 18%. Still we are at break even. We will reduce selling price initially. We will launch the project. As project has been launched at a cheaper price, it will become a success. And when project becomes successful, we will increase the price subsequently. And that's how you're going to capture the market. So that's why I was saying that we may reduce the price just to capture the market. Okay, that was the answer of your question. Okay, the third part in which you have to guide non-executive director about the importance of long-term and short-term maximization or long-term and short-term objectives. Okay, non-executive director has highlighted the importance of long-term maximization of wealth. You need to tell him about the short-term and long-term both objective. NPV is the most important indicator of whether investment is likely to do that. However, the assessment of investment using NPV has to be modified if the company is undertaking a number of different investment and capital is rationed. Yes, it is not necessarily the case that the investment with the highest NPV will be chosen and account has to be taken care of the amount of capital invested as well. So we need to So like that project which is generating more return by investing less capital. However, investors are not necessarily concerned solely with the long term. They are also concerned about short-term indicators such as the annual dividend. They may be concerned if the company investment portfolio is weighted towards project which will produce good long-term return, but limited return in the near future. Risk will influence shareholder views. They may prefer investment with a high proportion of return on weight in the short term if they feel that long-term returns are much more uncertain. So it totally depends. You have to guide to the shareholders about the both long-term and short-term projects. If your major projects are for the long term, you have to communicate your intentions about the short-term investments. What you have done for the short term, but what have you planned for the short term? So the payback method shows how long investment will take to generate enough return to pay back its investment. It favors investment which pay back quickly, although it fails to take into account long-term cash flows after the payback. Duration is a better way of distribution of cash flow. Duration will guide you that where major bulk of the cash flow, major chunk of the cash flows are available. If duration is short, that means major cash flows are for the short term. If duration is higher, that means major chunk of the cash flows you are receiving at the later years. So that was a discussion from the C part. Let's move to the third part, third question. Okay, just try to read this part. We will answer it in few minutes. We will discuss in few minutes. Okay, let's start the discussion of question number 3. The first requirement is discuss the benefits and drawbacks of the different policies which the three companies appear to have adopted. Provide relevant calculation to support your discussion. Okay, up to 5 marks are available for the calculation and 10 marks are available for the discussion. Second, discuss how the market cap of the three companies compare with your valuation. This is a market cap. Market cap means total market value. Compare with your valuation calculated using the different valuation model. Use the data provided to calculate valuation based on the growth rate for the most recent year. Growth rate for the most recent year and for the last 3 years. So it's a very detailed requirement. So let's have a discussion. Company gained a stock exchange listing 5 years ago. At the time of the listing, member of the family who founded the company owned 75% of the shares, but now they only hold just 50%. So they still got the control. Number of shares in issue has remained unchanged since company was listed. Company directors have continued the policy of paying a constant dividend per share each year, which the company had before it was listed. However, investors who are not family members have become increasingly critical of this policy, saying that there is no clear rationale for it. They would prefer to see steady dividend growth reflecting the increase in profitability. Okay, it's a point. Profitability, census listing. Finance director of company has provided its board with detail of company dividend and investment expenditure compared with other two similar sized companies in the same sector. Okay, these profits are given, dividends are given, new expenditures are given. The cost of equity, market cap, increase in share price. Company finance director has estimated the cost of equity for all three companies. None of the three companies has taken out significant new debt since 2011. So let's discuss the different policies of these three companies. First, you need to calculate the dividend payout ratio by dividing dividend with the profits. Okay, first you need to calculate dividend payout ratio. Let's suppose this company is paying 33 million dividend out of 77. That means its payout ratio is 42.9%, almost 42.9%. And in second year, its payout ratio is 41.25%. So that means out of 77, this company is paying 33. That means after paying dividend, this company has I think now you can see the screen. Okay. And like in 2012, try to understand this. First, you need to calculate dividend payout ratio. Then you need to know that you have earned 77 million, you have paid 33, and the remaining was 44 million, but you only have invested 18. That means if you are not paying higher dividend, you are not even retaining. That is the wrong policy. The best policy is to increase the dividend steadily over the time. But if you are not increasing the dividend, that means you are retaining. Like let's understand this company policy. Its total earning is 75, and this company is distributing 35. That means out of 75, this company is distributing 35. Its remaining funds are 40. And this company has almost invested all of the amount. This is a residual policy. Only distribute after investing in the relevant projects. So this company, after distributing the dividends or after investing into the capex, this company is distributing all the dividends. This company is following the best policy, like this company is distributing almost all of the cash flows as dividend after the investment expenditure. What about the second company? The second company is, let's have a discussion to answer. Okay, what we have done. We have calculated the payout ratio of these three companies. The payout ratio of first company is changing every year. But if we recall the question, if you open the question in another screen, the dividend of this company was same. Remember, this company was paying dividend every year, the same dividends. Every year the dividend was same. If dividend was same, but the payout ratio will be definitely different because profits are not same. And what about this company? This company was paying different dividends, but its payout ratio is constant. It's constant payout ratio. And even in case of loss, it is paying the dividend. And what about this company? This company has not any consistent payout ratio, but this company clearly shows that this is distributing all of the amount, almost all of the amount after investing in the capital expenditure. So what is this? Residual profit, after tax profit minus dividend minus new investment. So you have earned this much profit, you have distributed this much, and you have invested in this, invested in the new asset this much. So after paying dividend, after investing into the new investment, this company still has the very large amount of funds are available. Why this company is not reinvesting? If this company is not reinvesting, then this company should repay these amounts to its shareholder. Same is the case here. And this company is distributing almost all of the amount which are being left after investing in the suitable new investments. So what are the benefits? Obviously, the benefits of first company is that this provides shareholder with a stable and predictable income each year. Stable and predictable income each year. As profits have grown consistently, dividend cover has increased, which suggests that for now, dividend levels are sustainable. Company can sustain these dividends for a longer term. This is a positive signal to the market, but not exactly for all of the shareholders. Some shareholders will not be will not be satisfied with this policy. Why? Because they need a higher dividend in case if you are earning higher profits. If you go to the question back and see the trend of this company profitability is increasing, but their dividends are still stable. So they have indicated their preference for dividend level to bear a greater relation to profit level. Although they are still in a minority and cannot force the directors to pay more dividend, they are now possibly a significant minority. Ultimately, company share price could fall significantly. So obviously, if shareholders are not satisfied with your policy, they will sell their shares and they will invest in other companies. The dividend policy may have also been established to meet the financial need of the shareholder when company was unquoted. However, it is now difficult to see how it fits into the company overall financial strategy. The greater proportion of the funds retained does not appear to be linked to the level of investment. If you are retaining funds, you should invest those funds into the new projects. But this is not the case here. You are retaining too much funds that are being idle on your financial statements. So that was a discussion of the first company. Now let's move to the second company. In second case, company is paying consistently 40% dividend. And in 2013, if you go back to the question and see that company has not earned profit. In 2013, there was a loss of 10 million, but still company has paid 15 million. That is the sign that gives surety to the shareholder that in a regular years, we are paying you the constant payout ratio. And in case of loss, even in case of loss, we will pay you the minimum dividend. So we have maintained the payout ratio, and in case of loss, we will pay you the minimum dividend. That's how you can win the confidence of shareholders. For 3 out of the 4 years, company has been paying out dividend at a stable payout ratio. This may be attractive to some shareholders who have expectation that company profit will keep increasing. The year when the company payout ratio differed from the other was 2013, in which company made a loss, and even company has paid 15 million in that year. Although shareholders are guaranteed a minimum dividend each year, dividends have been variable, and because of the variation in dividends, some of the shareholders might not like this policy, because shareholder wants a steady increase in the growth of dividends. If company had another poor year like 2013, shareholder have an expectation of at least 15 million dividend, because in the previous 2013 year, company has paid 15 million, even company has not earned anything. Okay, having a normal dividend policy result in expectation about what the level of dividend will be. Over time, company manager may be reluctant to change to the lower payout ratio because they fear this will give shareholder inverse signal. And if in any year you change the minimum dividend policy, that you have maintained the 15 million, if you change this in the future, you will disturb the expectation of the shareholders. Okay, what about the third? In third, company dividends level are different. That company has not a consistent dividend levels in 4 years. That will disturb the shareholders, because shareholders need a consistent view about the dividends. But the positive thing about this company is that this company is continuously investing all of the funds into the new investments, and the amounts which are available after investing into the new projects are distributed to the shareholders. Okay, Company seems to have adopted a residual dividend policy which links investment and dividend decisions. Strategy appears to be to make investment if they offer sufficient return to increase long-term company value and only pay dividends if there are no more profitable investment. So this company has a policy to invest all of the funds into the new projects, and if funds are available, then distribute all of the funds to the shareholders. Assuming that internal funds are cheaper than external funds, this policy likely to appeal those shareholders which wants the capital growth. Dividend payments are totally unpredictable as they depend on the investment choices. Shareholder cannot rely on having any dividend income in a particular year. So this company will not be a good investment for those shareholders who want a predictable and stable dividend. Okay, these are the benefits and drawbacks of the company. Let's move to the second requirement, and the second requirement was, if we again see the question, second requirement was discuss how the market cap of the three companies compare with your valuation, and you need to calculate your value according to the 1 year growth and last 3 years growth, and then you will compare your answer with the given market cap. So let's the valuation of first company. This company is paying 33 million dividend every year. Divided with the cost of capital, its valuation is 300 million. Why we have not taken any growth? Because there is no growth. Company has paid a regular dividend every year, but its actual market cap is 608, which is considerably higher than this 300 million. This will suggest that investors have some positive expectation about the company. Company is not paying dividend with growth, but shareholders are expecting that in future company will increase the level of dividends. Investor could also be valuing the company using earning growth rather than dividend growth. That's why they are valuing it at a higher rate. However, the lower market cap compared with the other two market companies and the smaller increase in share price suggests that investors have higher expectation of long-term growth from the other companies. Okay, the other company 1 year growth rate is 9.1% and 3 year growth rate is 8.1%, and the value according to these two are 1068 and 879, and its actual market value was 1042. So that means most of the investors are thinking the most recent growth will be there in future. Company market cap is closer to the valuation suggested by the dividend growth model using the 1 year growth rate rather than the 3 year growth rate. This together with the recent increase in share price suggests that company shareholders have an optimistic view of its ability to sustain the profit growth, especially of the last year. Although its higher cost of equity than the other companies suggests that they are more wary about the risk of investing in this company. It indicates confidence in the director strategy, including the investment they have made. Okay, what about the third company? According to their growth, 1 year growth is this value and 3 year growth is 783, and its actual value is 11164. The market cap of this company is higher than is suggested by the dividend valuation model, but the dividend valuation model may not provide a risk valuation because dividend payable are dependent on the investment opportunities. Why this model is not giving the clear value? Because this company is not paying any regular or consistent dividend, or this company is not paying any consistent the growth of dividends in this company is not that consistent, because we have identified the policy of this company to invest in new projects, and if funds are available, then you will pay the dividend. So dividend valuation model is not that relevant here. So total earning or cash flow method will be more relevant. The larger increase in share price compared with the other two companies suggests that this company investors expect the investment to produce higher longer-term return. So that's why in market, its actual share price has been raised by 10%. So that's how you're gonna solve this question. This question was very general, and your answers can vary with the standard answers provided by the examiner. Okay, if you have any question from this part, please ask, and try to read the question number 4 requirement and the question number 4. This is question number 4. Using the current annual spot yield curve rates as a basis for estimated forward rates. So you need to calculate forward rate with the help of spot yield curve rates. Calculate amount company expect to pay or receive each year under the swap agreement, and you will exclude the fee of 25 basis point. Okay, the last part. Calculate company interest payment liability for year 1 if the yield curve rate is 4.5 or 2.9%, and comment on your result. And then we will discuss the B and C part. Let's read the question. Company is currently undertaking a major program of product development. Company has made a significant investment in plant and machinery for this program. Over the next couple of years, company has also budgeted for the significant development and launch cost for a number of new products. So nothing relevant with the first paragraph. Move to the second paragraph. Company has issued floating rate notes. Face value of 400 million. Its time is 10 years. Interest on these loans are payable annually and its rate of yield plus 50 basis point. Company Finance Director recently completed a review of the company overall financial strategy and they expect their interest rate will increase in the next few years. Finance Director is concerned about the exposure company has to increase in interest rate through the loan notes. He has therefore discussed with bank the possibility of taking out a 4-year interest rate swap. The proposed term are that company would pay bank interest rate on an equivalent fixed annual rate of 4.847%. That means we will pay the fixed rate and in return we will receive a variable amount based on the forward rates calculated from the spot yields minus 20 basis point. Payment and receipt would be made annually with the first one in a year's time, and then bank will charge a fee of 25 basis. Okay, there are two concerns. Company chairman wondered what the value of the swap arrangement to company and whether the value would change over time. Okay. The second, one of the company non-executive director objected to the arrangement, saying that in his opinion, the interest rate which company would pay and the bank charges were too high. Company ought to stick with its floating rate commitment. Investor would be critical if at the end of the year, company had paid higher costs under the swap than it would have done had it left the loan unchanged. Okay, let's solve the very first part. Let's try to understand the swap. What is swap arrangement? You have taken, this is your company, you have taken variable rate loan at yield plus, what was it? At yield plus 50 basis point. And you want to cancel this exposure. You want to shift your exposure. So you will go to the bank and you will exchange your exposure with this bank. This bank will pay you floating yield minus 0.2. This is given in the exam question. So you will receive this and then you will pay to your bond holders. And in return, you will pay fixed of 4.874% every year to this bank. So what is the structure here? How you gonna value the swap? This is a 4-year structure. Year 1, year 2, year 3, year 4. Every year you will have to pay 4.847. Every year you will have to pay 4.847% of 400 million. And every year you will going to receive the floating rate of this 400. And floating rates are based on the forward rates calculated through these yield rates. Okay, let's calculate it. The forward rate of year 1 is exactly the same as yield. Forward rate of year 2. What do you mean by this spot yield curve? This means if you invest for 2 years in the government bond, you will receive 4.25% per annum basis, but at the end of year 2. So that means you will receive 4.25% for 2 years at the end of year 2 for 2 times, because 4.25% is an annual return and for 2 years you will receive this 4.25% by 2 times. And if you invest for 1 year, you will receive 3.7%. So what about that investor who will invest after 1 year for a period of 1 year? How are you going to calculate it? You will calculate like this: 1.0425 raised to power 2, because you are going to receive 4.25% for 2 years, and divided it with 1.037 raised to power 1. That's how you're going to calculate the forward rate of year 2. And what about the forward rate of year 3? The spot yield of year 3, that is 4.7. What do you mean by this? This means if you invest for 3 years, you will receive return 4.7% per annum basis. At the end of year 3, you will receive 4.7% 3 times at the end of year 3. And what if you invest for 2 years, you will receive 4.25% for 2 years. And what if you want to invest after 2 years for 1 year? How are you going to calculate that? You're going to calculate that 1.047 raised to power 3 over 1.0425 raised to power 2 minus 1. That's how you're going to calculate it. So how examiner has solved it? Like, these are the forward rates. Two-year spot yield over the 1 year spot yield, year 2 forward. 3-year spot yield over the 2-year spot yield, 3rd year forward. 4-year spot yield over the 3rd year spot yield, 4th year forward. Okay. What is a swap structure? You will pay fixed. How are you going to calculate that? 400 million into 4.847. It's same entirely in 4-year time period. And what is this? The C floating. This was based on the forward rates less 20 basis point. Here it is. In first year, 3.7, you use 3.5, 4.8, 4.6, 5.61, 5.41, 6.31, 6.11. Multiply it with the 400 million. That's what you receive in a shape of floating. So you will receive floating, you will pay fixed. That is the structure of swap. And if you take present value of all these amounts, it will be equal to 0. Remember one thing, the initial value of swap contract is 0. Initially, the present value of fixed payment, the present value of floating payment will be equal, and the swap value at the start, at the inception, will be 0. In first 2 years, like, you are receiving less amount, but you are paying more. In 3rd and 4th year, you are receiving more amount comparing to the payments. Its total will not be equal to 0 because these are not the present values. But if you take present value at the spot yield, your answer will be 0. So you will pay fixed, you will receive floating, and that is 400 million into forward rate. The floating rates are based on forward rates minus 20 basis. and difference of all these years will be discounted, and present value of these cash flows will be 0. But swap value will not be 0 during the swap contract. It will be 0 like, let's suppose a 4-year swap. Its value will be 0 at the start of the contract, but its value will be positive or it can be negative during the 4-year period. How it can be positive or negative during the 4-year period? Your fixed leg has been locked, so it will not change. Every year you will pay this fixed amount, but these floating rates are just estimate. Actual floating rates are yet to come. So if floating rates, like let's say you are paying 4.8%, and if floating rates increases over time, that means you will receive a higher amount. And if you receive a higher amount compared to your payment, definitely swap contract will be positive for you. And if floating interest rate go down, that means you will receive less and you will pay more. In that case, your swap contract will have a negative value. So that's how the swap value changes over time. Okay, the next part, calculate the company interest payment liability for year 1 if interest rate increases or decreases. How are you going to solve it? Okay, you have borrowed from bank at yield plus 0.5%, and you are receiving yield minus 2%, 0.2%. And in return you are paying 4.847%. So it will not be negative. Yes, this will be negative. And you are also paying a fee of 0.2%. So what will be your after swap cost? Your after swap cost will be here it is. You had borrowed at yield plus 0.5. You will receive yield minus 0.2. You will pay 4.847. You will also pay bank fee. Your final cost will be 5.79%. So the analysis is very simple. If interest rate go down or interest rate go up, you have changed your exposure from floating to the fixed. So in both cases, you will have to pay 23.19 million. But if I ask you about the valuation of swap, definitely if interest rate go up, you are shifted into the fixed rate exposure, you will get the benefit. But if interest rate go down, definitely you will face loss. And in the second part, you will guide your chairman that at the start of the contract, the value of the swap will be 0. The term offered by the bank equate the discounted value of the fixed rate payment with the variable rate payment of the bank. However, the value of the swap will not remain at 0. If interest rate increases more than expected, company will benefit. If interest rate decreases than expected, obviously company will face loss. And in the last step, these are the advantages and disadvantages of the swap contract. So if you have any question from this last part, please write in the uh, question box. Okay, these are the general guidelines for exam. First advice, do complete your paper. You must complete your exam. Be confident. Never lose hope. If you stuck in any part, take assumption and try to solve that part. If you stuck in any numerical part, explain its calculation. You will get some marks. Don't panic. if you start, even if you start today, you can pass this exam. But try to remember these common guidelines. You must have to complete your paper, be confident, never lose hope. If you're stuck in any part, take assumption and try to solve that part. You will get some marks. If you're stuck in any numerical part, explain its calculation, you will get some marks. Do not panic. P4 is easy to pass if you follow these guidelines and if you have a stronger plan. And what is the meaning of stronger plan? Try to prepare all the main areas and confidently attempt the paper and confidently complete the paper. All areas are important because examiner always state in its examiner feedback that don't try to predict me. If examiner is stating that don't try to predict me, how can I give you some guess that this will be appear in exam? So this is not possible. All areas are important. Try to divide all the areas of P4 into the remaining days and try to prepare all the areas and try to solve the past paper questions, and especially try to solve at least 2 exam paper under time constraint, and time constraint means 3 hours. And one last thing, start your paper from easy question, and that easy question can be the question number 1, 2, 3 or 4. It depends upon your preparation. It depends upon your interest at which part of the syllabus you like more. Let's suppose if there is a question from investment appraisal and you feel confident, try to attempt that question. Like the paper which we have discussed, if its question number 2 is very easy, so try to solve that question first. You will get the confidence, and if you get the confidence, you can easily solve all the remaining questions. Okay, you know very well that in webinar we face time constraints, so we have covered all the major areas, but some of the more topics are relevant. Like, do prepare option pricing in a context of real option, and try to read the recent articles, as there is no article for this attempt especially, but try to read at least the recent articles. Because the question number 4, the interest rate swap, which we have discussed in the last, that was also from the article. So do read all the articles, especially the latest one, and do prepare the option pricing, especially in the context of real option. That's all from here. Best of luck for your exam. Our best wishes are with you. If you feel any problem in future, especially in next 10 to 15 days, do contact us. Thank you so much.